Good morning. Welcome to today's board meeting. We have two topics on our agenda for today. The first topic relates to redeliberations on our project on accounting for debt exchanges. And then we'll continue with our second topic related to our leases post-implementation review. So with that, let me turn it over to Emily and our accounting for debt exchanges team to tee us up this morning. Good morning, Emily.
Thank you, Rich. I will give a summary of the proposed amendments and the overall feedback received before turning it over to Julie to discuss question 1 in the handout. When an existing debt obligation is contemporaneously settled using cash received from the issuance of a new debt obligation entered into with at least one of the existing creditors and multiple creditors participate in the issuance of the new debt obligation, an entity would be able to evaluate proposed conditions to evaluate if the transaction is to be accounted for as an extinguishment under subtopic 47050. In issuing the proposed amendments, the board sought to address stakeholders' concerns that the current guidance is costly to apply and that accounting for certain transactions as modifications rather than extinguishments does not reflect the economics of the arrangement. The comment period for the proposed update ended on May 30th, 2025, and 17 comment letters were received on the proposed amendments. Overall, most respondents expressed support for the proposed amendments to reduce the cost and complexity in accounting for certain exchanges of debt instruments. A few respondents did not support the proposed amendments. One of those respondents stated that the proposed amendments could deter entities from entering the market for debt exchanges. The other respondent did not support the proposed amendments because of concerns that they could affect the information disclosed about the history of the debt instruments. The objective of today's board meeting is to discuss the comment letter feedback and redeliberate the proposal in order to be able to move forward to a final accounting standards update. I'll now turn it over to Julie to discuss issue A and question 1 in the handout.
Thanks, Emily. Issue A includes a package of decisions on key areas of the proposal, specifically the scope, conditions, and optionality. As a reminder, the proposal requires multiple creditors in the new debt issuance and introduces 2 new conditions in paragraph 470, 40, 59, A and B. Condition A requires existing debt be repaid at contractual terms or repurchased at market terms. Condition B requires new debt to be issued at market terms following the issuer's customary marketing process. Application of the conditions is required, not optional. Overall, respondents supported the proposal while providing a number of suggestions for improvement, as further discussed in the handout. Respondents supported including both exchanges involving multiple creditors and those involving a single creditor on the scope, noting no substantive difference between them. A few respondents also supported requiring a new creditor or making the proposal optional to improve operability. Regarding conditions, respondents mostly supported condition A. For condition B, respondents supported that new debt should be at the market, but did not support the portion of condition above following a customary marketing process. In response to the feedback, the staff prepared a package of alternatives included in the handout. Based on the overall feedback on the conditions, all alternatives have 2 elements in common, which are to affirm condition A and remove customary marketing process from condition B. The main difference between the 4 alternatives relates to the scope requirements for the new debt issuance. Alternatives A1 and A2 would affirm the scope to require multiple creditors. In addition, alternative A1 would provide indicators of market terms for condition B. Alternative A3 would expand the scope to single creditor and make the proposal optional. Alternative A4 would narrow the scope by requiring a new creditor. The staff recommends that the board maintain the scope to require multiple creditors and affirm the conditions while removing the notion of customary marketing process. Accordingly, there'll be either A1 or A2, depending on if the board is interested in adding indicators. With that, I'll turn it over to the board to discuss question 1 in the handout.
Okay, any questions, Fred?
Emily, you mentioned the comment letter that talked about the reduction in these instruments that would be issued. And I think it said these proposed amendments could almost completely deter US GAAP issuers from choosing exchange offer structures in the future. I didn't read any other comment letters that addressed the issuance, the impact on issuance, and I don't remember if the EITF discussed that at all. Do we have any evidence that that is wrong, or that one way or the other about what it will do?
While we think this proposal will result in more extinguishments of existing debt instruments, I don't think we have insight into how it'll affect the market, which was highlighted by that comment letter respondent.
And we don't know today how many of these exchange transactions get modification accounting, correct?
The staff understands from outreach and understanding of subtopic 47050 and the history of it that it often results in modification accounting, just given the nature of how the 10% cash flow test is designed. But we don't have any other insights as it relates to that.
But if we do require this, then it could have a significant impact on issuance if it pushes things into extinguishment if they're currently in modification. And that's one of the reasons people might have wanted it.
Yeah, I think the staff thinks just by the nature of the proposed amendments, we would result in more extinguishments.
Right, or reduced issuance.
Or reduced modification, sure.
Right.
Yep.
Thanks.
Emily, when we talk about indicators, and indicators are always kind of interesting, do we think anybody could have all of the indicators and still conclude it was not the customary marketing process?
That could be a possibility. We didn't mean the indicator to be comprehensive or all exclusive list of things, but it could be deemed as a checklist of requirements. But we don't have. We were thinking more of drafting. It may require careful thinking to highlight that as helpful factor, not precluding or restricting entities apply, the conditions based on their specific facts and circumstances.
Yeah, the reason I was asking is my experience with indicators in other parts of GAAP is they become checklist requirements. So if we do support indicators, it sounds like we would be clear that just because you had the indicators would not be the answer. You wouldn't reach that answer. So do we think there's a substantive difference between having indicators and not having indicators?
I think the main reason we put forth the indicators as an option was some of the feedback we had heard about if we just left it at market terms. I think some of the comment letter respondents and some of the outreach respondents had a concern that that might be viewed to be a requirement to go get a fair value of the debt to prove that it's at market terms. So we were just trying to think about how could we kind of, no pun intended, indicate that this is maybe more of a qualitative assessment than a quantitative assessment. But that said, even without indicators, we could try to emphasize that in the basis, because I think we just don't want to see practice evolve to say, well, I don't know if it's at market terms unless you will get a valuation. And that, I think, was what we were trying to prevent. But I think there's other ways that we could do that without the indicators.
Okay. And I appreciate you gave us multiple examples, one without an indicator. I just wanted to understand that. Okay. Any other questions? All right. Not seeing any. So.
Thanks, Rich. So I really appreciate the staff work on this project, and I appreciate the supplemental outreach that you did that was incorporated in the memo, and even what you did in the last few days. And certainly for those that actually participated by providing us comments and participating in that outreach. I think when we were in this phase where we were in initial deliberations, I certainly was maybe a little bit skeptical about the additional requirement that we have in 9B about following the issuer's customary marketing process for new debt issuances. You know, it's sort of labeled included in there as a description of what market terms may be. So I was really pleased to see that we actually got a decent amount of feedback on it. And some of the reason I was a little bit concerned was some of the dialogue at the time with the EITF when asked about how would it be operationalized. Sort of the sentiment was, well, we'll know it when we see it. And that's really hard to audit, and it's hard to capture in the COD. So I think when I think about this requirement, I'm supportive of removing that phrase customary marketing process as part of the condition of the alternatives that provided by the staff. I do support alternative A2. As Julie noted, I think the primary difference between A1 and A2 is whether the indicators are included or not explicitly in the COD. I think your question was helpful. I hadn't thought about it as terms of if you met them, could you ever not meet it? So I think that's a useful question. But I'm not going to support A1 because I'm concerned that in my experience, I have a similar experience that Rich has, that a list of indicators is interpreted as rules and it is applied generally in a checklist type of way. And so if you meet these two, then I don't know that there's ever a scenario where you would be outside of it. It would be hard to interpret it that way. However, I do think some of the attributes are useful in understanding whether this has been issued at market terms. And I think that some of the respondents said as such in the comment letter process. Maybe just a comment on optional versus required. You know, I think A2 clearly incorporates the notion of required. I think if we went down the path of optional, I would question why we actually need to issue this ASU at all. So for all those reasons, I'm A2.
Right. Fred?
Oh, we get to the other side of the debate. Thanks. So I support A3. I think it's most responsive to the stakeholder feedback that we received. I agree with the comments that there's no reason not to address single transactions, especially, which I'll come back to in terms of it being optional. And so I think I like the broader scope that would entail. And I think the criteria works well for single issuers in terms of a streamlined way to get to extinguishment accounting. The other reason I am concerned that we unintentionally, or maybe intentionally, are going to essentially, as the comment letter said, almost completely deter U.S. GAAP issuers from choosing exchange offer structures in the future. You know, I don't think this was fully debated, and I think that certainly we don't have a counter argument to that. And I don't believe necessarily that we want to deter all those exchange transactions. And that's really the reason why I think optionality is helpful. I have to say I take the other side of Sue's argument in terms of this. I believe it still would be very effective if it's optional, because really what we're doing is we're providing a shortcut to get to extinguishment accounting where there are these difficulties that practice is running into. So as a result, I think optionality would be helpful. I would certainly there would be some concern about optionality always, you know, allows perhaps structuring or these other things. But I think in this case, really, we're trying to allow a streamlined approach to extinguishment accounting and that extinguishment accounting is more transparent to investors. So that's really all we would be doing. I would say, though, that if I can convince anybody for A3, I would agree on Sue's comment relative to the indicators. And I would strike the indicators. So it would really be an A3 prime that I would be supportive of. Thanks.
Thanks, Fred. Joyce?
Thanks, Rich. So my views are similar to the ones that Sue has expressed. I support alternative A2. I think the stakeholder feedback regarding applying the customary marketing process notion was quite on point. It was terminology that I had concerns with at our prior board meeting in terms of just the broad applicability as well as the potential of inconsistent application across stakeholders. I am concerned that creating indicators would potentially be interpreted as guidance, which would bring us back to the respondents' concerns regarding the customary marketing process. So preparers, for example, who rarely issue debt and therefore may not have an established marketing process, may look at that indicator and determine that they are in fact not meeting that level. Once again, because they may interpret this as guidance in spite of whatever clarification that we may put forth in the guidance. I agree with the respondents who suggested that market terms should be a sufficient characteristic in the conditions. And as we saw broadly, the outreach respondents did not need any further clarification of the market terms. So I think that would be sufficient, and we've already noted that largely in the basis for conclusions where we discussed that the issuance of the new debt obligation at terms that reflect current market conditions and the debtor's creditworthiness would be sufficient to indicate the issuance of a new debt obligation and the repayment of the existing debt instrument are independent, separate transactions. Regarding the applicability of multiple versus single creditors, when the EITF raised this issue, they noted a problem, and that problem was characterized by the challenges of the debtor to determine the identity of all the creditors in widely held debt exchanges to perform the 10% test on a creditor by creditor basis. It was a very specific, narrowly scoped problem. And there were concerns around the different interpretations and the application of the guidance to debt exchange transactions with multiple creditors. And it could result in different accounting outcomes for similar transactions. So I think the multiple creditor characteristic importantly drove this project. It drove the EITF assessment and recommendation. They expressed that it is those transactions that commonly present the issue in practice. So in my view, I think the scoping decision that addresses that narrowly identified issue should not change to a single creditor in this project.
Okay, thanks, Joyce. Marcia?
I appreciate all the feedback that we received, and I also appreciate the comments that have been made. I respect them all, but I think that I interpreted the feedback that we received to be primarily very supportive, that to respond to the question that was raised, as Joyce just articulated, keeping the scope narrow is responsive to that there was a lot of support for keeping the scope narrow. I agree that when we receive comments that language we've used, such as ordinary marketing terms, is difficult to understand. If it's not particularly helpful, I'm very comfortable removing that language. And I understand that between alternative A1 and A2, which is keeping the scope the same, making this a requirement so that we do meet the objective of getting consistent treatment for like transactions, that of the two choices, I view alternative A2 as being the lower cost option of the two, because I think when we do have indicators, that drives a lot of behind the scenes discussion that doesn't really impact the outcome, may not be value added, could be costly. So I'm going to support alternative A2.
Thanks, Marcia. Christine?
I find this one interesting because I think what we're saying is that there are circumstances in which applying a rule is hard. And so what we're doing is we're putting in place a principle that can be followed instead. And I always prefer principles over rules. So I think that the principle that we're going to be adding should be, if properly applied, effective in identifying situations where economically there's been an extinguishment, right? We've got an existing debt that's been settled at contractual or market terms, and we have a new debt that was issued at market terms, and that to me seems to be what I would expect if there was an extinguishment of an old debt and issuance of new debt. So I think this principle, if it's properly applied, will capture the right set of transactions and treat them appropriately according to their economics. So I'm not supportive of an option as a result. I think that the indicators, that there is this checklist mentality, that it potentially could interfere with the application of the principle and the application of judgment. And as a result, I wouldn't support the indicators, which puts me into alternative A2. Thanks.
Thanks, Christine. Hillary?
Yeah, thank you very much to the team for all of their analysis and for all the feedback that we got. The short answer is I'm A2 for many of the reasons that were stated by board members. I will say, to Fred's point, with an interest in looking at how should we be looking at this from a single creditor perspective. I certainly have interest in that, but probably not in this project, right? And I think about it from kind of Joyce's perspective of the narrow issue that was really brought in and addressing that issue now. But I do think that there is potential opportunity to think about the debt modification versus extinguishment guidance a little bit more broadly. I think for purposes of this project, I wasn't thinking of the conditions that we've put in place as necessarily, would those be all inclusive for a single creditor? And so I don't think I'd be in a position to expand it. So certainly agree with the scope related to the existing, what was proposed. With regards to the conditions, agree with 9A. And with regards to 9B, I think similar to what folks have said with regards to the, and I will say, I personally may think that you could apply customary marketing process. I think that there could be judgment applied and it could be applied in practice. I take the feedback from our stakeholders that that was something that they were not comfortable with. But in that same reasoning, if we're not comfortable with it as part of a condition, I don't know why we'd be comfortable with it as part of an indicator without providing additional implementation guidance of how to apply that. And I certainly do think that putting these as indicators would in effect make them requirements. And I do think the EITF thought about whether a new creditor needing to be added should be a requirement and decided not to add that, and the board agreed with that. So I think we'd be effectively going back on that decision if we were to include that as an indicator. But I do think some additional discussion in the basis for conclusions could be really helpful if we think about, what are potential things that you can think about when whether or not you've issued the debt at market terms, right? I think we could do a little bit more in the basis to help our stakeholders understand what's intended by that. And probably more importantly, what's not intended, right? Which is, it's not intended that you go and get a fair value, have a valuation completed on your new debt to ensure it's at market terms, right? I don't think that's what we're looking for. And I think being very explicit with regards to that would be very helpful. And I also agree with keeping this required, right? I think to Marcia's point and others, making sure that similar transactions are accounted for similarly, I think is very important and was one of the main reasons that we were asked to take on this issue. So very supportive with regards to alternative A2.
Okay, so I'll also support alternative A2. And I think probably the difference between A2 and Fred's proposal is whether you view this as the start of the decision tree or you view it as a practical expedient to help you get through the existing decision tree. And I view it as the start. So that's kind of where I come from. And I do view it as a principled approach to what's an extinguishment versus what's a modification. On the concerns on the market reaction, I find that interesting because to have a concern, that must mean there's a concern there's a material gain or loss, but that somehow you're getting through the 10% test today, which I don't get. So I'm that part I don't necessarily follow. I come back to, I think these transactions that if they meet the criteria that we've set forth are in substance extinguishments. And I think presenting them as such makes the most sense. So I'm okay with that. If it has some effect, maybe that's good that it has some effect. And we should understand that. But I do kind of struggle that it's going to have an effect on something that would have gotten through our existing guidance. I do find that interesting, a material effect. With that, let me turn it back to Emily for issue B, question 2.
Perfect. Thank you, Rich. I will now discuss question 2 in the handout, which relates to other feedback received related to the term contemporaneous exchanges of cash. One respondent suggested that the board clarify that the repurchase of the existing debt obligations does not need to be settled on a gross basis to meet the conditions. Another respondent provided a similar suggestion. Additionally, one respondent requested that the board clarify the phrase contemporaneous exchanges of cash in paragraph 470-40-9. That respondent stated it was unclear whether exchanges of existing notes into new bonds would be affected by the amendments in the proposed update. The staff considered the feedback and notes that paragraph BC 36 of the proposed update states that the EITF considered but did not recommend including an additional condition whereby a contemporaneous exchange of debt instruments would be required to be settled on a gross basis to qualify as the issuance of a new debt obligation and an extinguishment of the existing debt obligation. Therefore, the staff thinks that it was the board's intent that an exchange of debt instruments does not need to be on a gross basis to meet the proposed conditions in paragraph 470-50-40-9. Therefore, the staff recommends that the board clarify within paragraph 470-50-40-9 that the phrase contemporaneous exchange of cash can be on a gross basis or a net basis. I will now turn it back to the board to discuss question 2 in the handout.
Okay. Any questions? Do you have to swap checks or not? Right? Okay. Fred?
Support the staff recommendation.
Marcia?
I also support the staff recommendation.
Joyce?
I support the staff recommendation.
Sue?
I support the staff.
Christine?
I support.
Hillary?
I support the staff recommendation.
And I also support the staff recommendation. All right, Emily, back to you.
Thanks. I will now discuss question 3 in the handout, which relates to other feedback received related to the treatment of fees and costs under the proposed amendments. The proposed amendments specify that the guidance in paragraphs 470-50-40-17 through 18 was not applicable to exchanges of debt instruments that meet the proposed conditions. Accordingly, some respondents requested clarification on the treatment of fees under the proposed amendments if those paragraphs are no longer applicable. The staff considered the feedback regarding the treatment of fees and third-party costs. As a result of this feedback, the staff has presented 2 alternatives to the board to clarify the treatment of fees and third-party costs when the conditions in 470-50-40-9 are met. Alternative B1, require that an entity apply the guidance in paragraph 470-50-40-2, or alternative B2, require that an entity apply the guidance in paragraphs 470-50-40-17A and 18A. Under alternative B1, the fees and costs associated with the existing debt obligation are extinguished because the amendments in 470-50-40-9 treat the extinguishment of the existing debt obligation and the issuance of the new debt obligation as separate transactions. Under alternative B2, the fees and costs are treated in a manner consistent with other debt modifications and exchanges, that is, under the 10% cash flow test, because the amendments in 470-50-40-9 are considered a gating analysis before performing the 10% cash flow tests. The staff supports either alternative because it thinks that either clarification would improve the operability of the guidance so that entities understand the treatment of fees and third-party costs. I will now turn it back to the board to discuss question 3 in the handout.
Okay, so let you get a drink of water. All right. So Emily, just to help me, right? So we described this as a gating issue. If you get through the gate, if it gives you the answer, you're done, right? If you get through the gate, you go down and do the 10% test. if you do the 10% test, which is the guidance that we have today on modifications versus extinguishments, we would direct someone to paragraphs 17A and 18A. And that's effectively just says split it this way, right? It says you have existing debt, you have a modification, just split it this way. 40-2, if alternative, so if we had the consistent model with the conclusion on extinguishment or modification for the 10% test, we would go with 17A and 18A. If, however, we wanted in this initial step to create a different model, we would go to 40-2, right? So that would mean you get different accounting for the fees and costs, depending on where you exit the decision tree, right? Step 1 or step 2. If I go to 40-2, which wasn't written in the context of new debt, right? It was written in the context of an extinguishment alone. It does say that, and you were very careful in your words, I listened to you, you said that the costs associated with the extinguishment would be expensed. But if there are costs and fees associated with the new debt that's done all at the same time, you would have to bifurcate those out and treat them as part of the debt issuance. Is because that would be an additional right that you'd have to give appropriate recognition to under 40-2. Is that correct?
Yeah, the staff thinks that you're describing it correctly, because 470-50 40-2 is really only contemplating the extinguishment of the existing debt obligation and wasn't written in contemplation of a contemporaneous exchange. And so therefore, the staff thinks that if you had the information available, an entity would have to determine which piece of the third-party costs would be allocated to the extinguishment of the existing debt obligation and which costs would be associated with the new debt obligation. The new third-party costs would be treated in a manner consistent with paragraph 470-50 40-18A.
18A,
Yep.
okay. So if we prefer 40-2, one thing we might want to specify is whether you want to be explicit that you have to bifurcate those costs, do some kind of allocation, and treat them as new debt issuance costs, right? If it's an extinguishment. Understand. Do we think that 17A and 18A, right, seem like they were just pretty much throw your fees in this bucket, throw your costs in this bucket, don't try to allocate them? Do we think they did that because maybe it's hard to allocate them? And it was just in a way of getting to an answer? I mean, I don't know if these are generally material. That would be my guess.
We think that it's intended because it's an 17A and 18A are an extinguishment accounting, that it's intended to get you to a manner consistent with the extinguishment of an existing debt obligation and the issuance of a new debt obligation, because the third-party costs are treated as a debt discount, whereas the fees paid or received to the creditor are treated or accounted for in the extinguishment gain or loss.
Okay. But it's pretty clear what you do versus if we go to 42, someone's going to make an allocation.
Correct, if there could be a potential allocation under 40-2.
Why would there only be a potential allocation?
I think if you understood or had insight into whether the third-party costs were related to the extinguishment of the existing debt obligation, I guess if you couldn't determine it and it wasn't determinative, then that might be another question. So,
Okay, understand. And then if we did go to 40-2, someone might question, should we change the accounting for these costs for people who fail the 10% test if we want one model for extinguishments and modifications, right? Because I'm going down my flow chart, right? I started off with this principle, then I go to my rule. So if the principle I say it's an extinguishment, I'm going to go somewhere. If I get through that and I get to the 10% test and I determine it's an extinguishment under that, I might get different accounting for the fees and the costs depending on which off ramp I take from my model if I go to 42.
yeah, I think the staff thinks that while those might get you to the same outcome, there could be differences, albeit I think we understand from outreach we perform that the fees and costs are typically not significant numbers. So I don't know how much of a difference you would get.
Right. But we would be setting them to two different accounting models.
Correct.
Okay, understood. All right. Any other questions? Anybody want? Sue?
Thanks, Rich. And I thought that dialogue was useful, so appreciate that. I support alternative B2, I think primarily because it leverages current guidance. And it seems, particularly after that last conversation, less complicated to apply than alternative B1, which I think in most circumstances would require some sort of allocation guidance to ensure some, like for us to develop more allocation guidance if we actually wanted it to be applied in a consistent way. I acknowledge that B1 is probably more conceptually pure, but just given what you've just told us, Emily, it doesn't seem like the research has demonstrated that this level of precision from requiring an allocation will actually provide meaningful or perhaps even materially different information. So I think for all those reasons, I would support alternative B2.
Okay. Thanks, Sue. Joyce?
Thanks, Rich. So I support the staff recommendation. I think alternative B1 is it's in accordance with the principle of that's guiding this amendment. And conceptually, I think it is in line with what we're trying to achieve, and that is that the extinguishment of the existing debt obligation and the issuance of the new debt instrument are independent transactions. And therefore, the fees and the costs related to the existing debt obligation are extinguished and to be included in the extinguishment gain or loss. In the event, I think, and the discussion that ensued, I think was certainly very interesting. And I think that if in practice, there are concerns that are later raised regarding the allocation of the fees and costs, whereby it becomes some pervasive issue that it is not determinable through some sort of allocation process that's created by preparers, then at that point in time, I think that there should be consideration made regarding whether or not a research project may be necessary in order to perhaps provide guidance in that regard. But I don't think that at this time that is necessary.
Thanks, Joyce. Marcia?
Conceptually, I think I support alternative B1. For practical purposes, I'm going to vote for alternative B2. I think that bifurcations are complicated. I think that these fees in general are not likely to be material to the size of the debt. So I don't feel that adding complexity in determination for an outcome that's not going to be significant is, again, cost effective. I appreciate what Joyce said. Like I said, conceptually, it seems an extinguishment is an extinguishment, whether it's through this vehicle or another vehicle, and that the fees should be treated the same way. However, this is a different transaction because it's a simultaneous. And the discussion that we had about bifurcating the fees, I think was persuasive. So I'm in B2.
Fred?
I'm in B2 for the reasons Marcia cited. I thought B1 was more conceptually pure, but B2 is practical. And I think these are the impact is generally not going to be material on the output of the results.
Christine?
I'm in B1. I won't reiterate what Joyce so eloquently said because I agree with her perspectives, and that was my thinking as well.
Okay. Hillary?
I see the merits for both B1 and B2. Don't worry, I will vote. I will vote for B2. But I think it really comes down to where are you drawing the line, right? Some folks would say, is this the criteria that's met to make it an extinguishment? So account for it similar to the 40-2 debt extinguishment guidance, or this is part of the 470-50 guidance. If we would not have issued this guidance, or if this guidance doesn't get issued at all, you'd be going through the 10% test and you'd be following the guidance in 17A and 18A. So I do think it's where do you draw that line? And I can take Rich's point with regards to if we were to put this towards the 40-2 model, does that call into question how we think about accounting for the fees and costs of extinguishments under the existing 17A and 18A, which I have no interest in currently relooking at that and changing the model for folks who get through the or have an extinguishment under the existing modification extinguishment guidance. I do think that these fees typically are not material. I can understand both perspectives, but I think from a practical standpoint, people know how to apply the guidance that exists today. We don't get questions about that. And given the fact that these are likely not material in many circumstances, I think continuing to apply that existing guidance in a consistent manner would be helpful.
Okay. So I'll support B2. Interestingly enough, I would have supported B1 if we changed it for everybody, meaning every time you have an extinguishment and / modification, so fail the 10% test. But that's not what we're doing. We're talking about creating a separate off-ramp as part of the modification extinguishment guidance. And I think we should treat fees and costs the same. So put me down for B2. I think if we ever want to, and we hear there's a concern about fees and costs in modifications versus extinguishments under existing guidance, i.e. the 10% test or this guidance, maybe we should look at it holistically. But my experience is similarly that I'm surprised people want us to do a lot given the likely size of these amounts. So, all right, with that, back to you, Emily. Question 4.
Yep. Thank you, Rich. I'll now discuss question 4 in the handout. Question 4 in the handout relates to other feedback received related to the interaction between the guidance in subtopic 47050 and the guidance for induced conversions within subtopic 47020. One respondent questioned whether the settlement of an existing convertible debt instrument through an inducement offer would meet the condition in proposed paragraph 47050 40-9A and suggested that the interaction between the guidance in subtopic 47020 and subtopic 47050 be clarified. That respondent provided an example in which an entity issues a convertible debt instrument that can be settled in cash, shares, or a combination thereof, and subsequently makes an inducement offer to the holders of the instrument that is settled fully in cash. If the issuer contemporaneously issues a new debt instrument to multiple creditors, including the existing creditors of the convertible debt instrument, that respondent stated it is unclear whether these two transactions should be viewed independently of each other. Therefore, that respondent noted that it is unclear whether an entity would first apply the induced conversion guidance under subtopic 47020 or the proposed amendments in paragraph 47050 40-9. Additionally, the respondent stated that it is unclear whether the settlement of the inducement offer could be viewed as preserving the form and amount of the existing conversion privileges if there is a contemporaneous issue of new debt to the same lender. The respondent noted that the transaction could be viewed as either not preserving the form and amount since the existing debt was settled at least in part by issuing a new debt instrument, or preserving the form and amount because the existing debt instrument was settled for cash, notwithstanding the fact that the issuance of the new debt instrument occurred contemporaneously. The staff considered the feedback discussed regarding the interaction of the guidance on induced conversions in subtopic 47020 and the guidance on exchanges of debt instruments in proposed paragraph 47050 40-9 and whether this interaction should be clarified as part of this project. The staff understands from outreach performed when an inducement offer is accepted, many practitioners first analyze the transaction under the induced conversion guidance in subtopic 47020 to determine whether the transaction should be accounted for as an induced conversion under that guidance before analyzing the guidance within other topics such as subtopic 47050. The staff thinks that the approach described by practitioners is implied by paragraph 47050 50-3, 15-3, which indicates that conversions of a convertible debt instrument pursuant to the terms that reflect changes made by the debtor to the conversion privileges provided in the existing terms of those debt instruments, including changes that involve payment of consideration for the purpose of inducing conversion, are not within the scope of subtopic 47050. That is, the staff thinks, on the basis of the guidance in paragraph 47050 15-3, an entity would first need to determine whether the transaction is within the scope of the induced conversions guidance in subtopic 47020 before applying the guidance in subtopic 47050. The staff also thinks that this approach is similar to the analysis performed for troubled debt restructurings under subtopic 47060, whereby an entity would first analyze the guidance in subtopic 47060 before applying the guidance in subtopic 47050. Therefore, the staff recommends that the board clarify within the amendments to subtopic 47050 the interaction between subtopic 47020 and subtopic 47050 as part of this project. That is, the staff recommends that the board clarify that an entity would first assess the guidance in subtopic 47020 to determine whether the transaction involves conversions of a convertible debt instrument pursuant to terms that reflect changes made by the debtor to the conversion privileges provided in the existing terms of those debt instruments, including changes that involve the payment of consideration for the purposes of inducing conversion. The staff thinks that this clarification will alleviate concerns about the interaction between subtopic 47020 and subtopic 47050 that was highlighted by the comment letter respondent. The staff thinks that the respondent's concerns regarding preserving the form and amount of the existing conversion privileges if there is a simultaneous issuance of a new debt to the same lender is outside the scope of this project because that guidance is included within subtopic 47020. Therefore, the staff does not recommend providing additional clarification for this point of feedback. I'll now turn it back over to the board to discuss question 4 in the handout.
Great. So maybe just my words. We've got questions on should we specify the ordering of an analysis. We think people are doing it in the order that the staff is recommending today. We think you probably could read the codification today to get you there, but it would probably be helpful to specify that in this project.
Yeah, correct.
And then so that's the first question. And then the second question is really, do we want to do more in this project? Okay. Thank you. Any questions for the staff? All right.
So I agree with the staff recommendation on providing this clarification in the codification. And as it relates to the second point, I don't think we need to do more.
Okay. Joyce?
I also agree with the staff recommendation and additional work is not necessary.
Okay. Marcia?
I agree with the staff recommendation, and I do not think we need additional work.
Okay. Fred?
I'll agree with that.
Christine?
I also agree with that.
Hillary?
I also agree with that.
And I'll add my agreement. It's yes and no additional work. All right. Back to you, Emily.
Thanks. I'll now discuss question 5 in the handout, which relates to other clarifications received by comment letter respondents. Paragraphs 21 and paragraphs 43 through 44 in the handout include various clarifications from other comment letter respondents. Question 5 asks the board if it wants to revise the proposed amendments to provide for any of the other clarifications that were suggested by comment letter respondents. I'll now turn it back over to the board to discuss question 5 in the handout.
Okay. Any questions on issue 5? All right. So
I agree with the staff recommendation. I think there are a couple suggestions where the staff provided some commentary on potentially just tightening up the drafting and or in the basis. And so I would support those initiatives.
okay. Joyce?
I support the staff recommendation, and I also agree that those areas that you identified as requiring drafting in consideration of the stakeholder feedback should be done.
Marcia?
I also agree.
Fred?
Agree.
Christine?
Agree.
Hillary?
I agree with the staff recommendation, but but there are at least one where I don't agree with the amendment. We can deal with that as part of drafting.
So I agree with the staff recommendation and happy to improve the drafting if we can. All right. Connor, good morning.
Good morning. Thank you, Rich. I will now discuss questions 6 through 9 in the handout, which relate to transition method, disclosures, effective date, and early adoption. The amendments in the proposed update would require an entity to apply the new guidance on a prospective basis to exchanges of debt instruments that occur on or after the initial date of application. An entity that applies the guidance prospectively would be required to disclose the nature of and reason for the change in accounting principle in the financial statements. Comment letter respondents largely agreed with the proposed transition method, and none expressed support for a different method. Some respondents supported the transition disclosures, noting that the requirements would be clear and operable and provide decision useful information. However, one respondent suggested that disclosures should be required only in certain circumstances, which is highlighted in paragraph 50 in the handout, and noted that the transition disclosures should be optional if those circumstances are not met. Another respondent stated that the transition disclosures are unnecessary because the proposed amendments affect individual transactions and the effects of those transactions are already required to be disclosed. A few other respondents deferred to users on whether the disclosure would provide decision useful information. The staff notes that while the proposed amendments are applied to individual transactions, the staff thinks that respondents that provided feedback on the transition disclosure agreed they would provide decision useful information and was clear and operable. Therefore, the staff recommends that the board affirm its decisions to require an entity to apply the proposed amendments on a prospective basis and disclose the nature of and reason for the change in accounting principle in the period of adoption. As it relates to effective date for public business entities and entities other than public business entities, several comment letter respondents indicated that little time would be required to implement the proposed amendments. Other respondents suggested that the effective date should be the same for all entities, with 1 year cited as sufficient time to implement for all entities. Conversely, a few respondents noted that entities other than public business entities should be granted additional time to implement the proposed amendments. One of those respondents recommended a 2-year implementation period for public business entities with an additional year for all other entities. After consideration of comment letter feedback, the staff believes that public business entities and entities other than public business entities will not require significant time to implement the proposed amendments. The staff notes that the proposed amendments are intended to reduce diversity in practice and enhance operability without making fundamental changes to the existing guidance. Therefore, the staff thinks the deferred effective date for entities other than public business entities is not necessary. The staff recommends that the board require the amendments in a final update to be effective for annual reporting periods, including interim reporting periods within those annual reporting periods, beginning after December 15th, 2026 for all entities. The proposed amendments would permit early adoption, and many comment letter respondents agreed that early adoption should be permitted for financial statements that have not yet been issued for public business entities or that have been made available for issuance for all other entities. One of those respondents noted that the lack of comparability among entities that choose to early adopt and those who do not early adopt would not introduce significant difficulties. Several respondents stated that an entity that elects to early adopt should not be required to adopt the proposed amendments at the beginning of an annual reporting period because the amendments would be applied to individual transactions. Another respondent deferred to other stakeholders, but noted that the cost of requiring entities to adopt as of the beginning of an annual reporting period would outweigh the benefits. A different respondent stated that entities that elect to early adopt the proposed amendments should be required to adopt them as of the beginning of an annual reporting period. That respondent noted that the consistent method of accounting would make it easier for users to understand an entity's operating results and financial condition. As a result of this feedback, the staff has presented 2 alternatives to the board for early adoption. Alternative C1 is should early adoption be permitted only as of the beginning of an annual reporting period, or alternative C2, should early adoption be permitted as of the beginning of an annual or interim reporting period. I will now turn it over to the board to discuss questions 6 through 9.
Okay, any questions for the staff? And just to be clear on question 9, the only difference between C1 and C2 is if someone has multiple transactions during the year. And in that case, C2, you get different accounting for the same transaction than the annual financials. Under C1, you'd get the same accounting.
Yes, that's correct.
Okay. Pardon me. So,
So I agree with the staff on questions 6, 7, and 8. I think that, based on the feedback that we got in the comment letter process, I think that the effective date that you've chosen is appropriate to be applied to both, to all entities. I think that, when I think about what we're actually doing here, we're actually making it easier to apply this guidance. And so I would hope that, to the extent a private company, say, for example, had this circumstance or this type of transaction, that they would want to apply this guidance because it's more clear. And I support early adoption. As it relates to question 9, I think it's kind of interesting because from a consistency point, I think we've been leaning more towards C1. But on the other hand, I think there was a lot of good discussion in our small group meeting, particularly some feedback that Joyce had provided about how investor would use that restated information and, whether it really was worth the cost of restating it for the little benefit that they would derive from it. And so I think that was very useful. And so from that perspective, I think given how an investor might use that information or not use that information. And I also think that I wouldn't necessarily want to discourage early adoption. I think in this circumstance, support C2.
Joyce?
So I support the staff recommendations for 6, 7, and 8. Regarding question 9, I guess you can conclude that I agree with what Sue's mentioned. So I prefer alternative C2. I would not require early adoption as of the beginning of the annual reporting period. A significant majority of the comment letter respondents to this question stated early adoption should not be required as of the beginning of the annual reporting period. So it is responsive to what we've heard. And I think one of the comment letter respondents expressed it quite well in their letter to say that requiring would introduce unnecessary complexity and potentially require reassessment of prior period transactions under the new framework. Debt modifications and refinancing are standalone transactions, and revisiting prior period transactions will not be cost beneficial, particularly if the information required under the new guidance was not captured at the time of the original transaction, end quote. So I think that, that's a pretty strong and powerful way to argue for it. Furthermore, companies may defer early adoption to avoid the potential costs of retrospectively recasting transactions that occurred in prior interim reporting periods. And of course, as Sue has mentioned, I think about the challenge to investors if early adoption is required as of the beginning of the annual reporting period. Investors perform quarterly analysis, which would have been completed and decisions made and factored into their financial projections in the quarter that the individual transaction was first reported. So investors could be subjected to potentially incurring costs to revisit, unwind, or potentially reassess the impact that is in their metrics and incur those costs under alternative C1.
Okay. Thanks, Joyce. Marcia?
So I agree with the staff recommendations. Yes on 6, 7, 8. As it regards to question 9, one of the items that we discussed in my small group was when we think this guidance would be issued. And what I remember hearing in that discussion was that it would hopefully be in January of 2026. Of course, the comments that we received in the comment letter responses did not know the date at which we would think about requiring this guidance or it being effective. So there seems to be support for the recommendation that this would be effective in calendar 2027. So I think we're talking about a relatively short early adoption period, which I fully support. And I think we're talking about language that would be available early in the first quarter before there would be any public companies that would be reporting any first quarter transactions. So it seems to me, while I understand the need to clarify in the language alternative C1 and C2, they feel to me like it's very much a distinction without much of a difference in practice. That if there is an entity with a first quarter transaction, we don't have a lot of feedback, as I recall from our conversation, with regards to how common it would be for there to be two of these types of transactions in a reporting entity in the same calendar year that would not be in the same reporting period. I'm going to support alternative C2 because I view this as a transactional type of guidance. And I do think that requiring a restatement is something that we should be real thoughtful about. But I feel, again, in practice, that there's not going to be much of a difference in what's publicly reported between alternative C1 and C2 with this effective date.
Thanks, Marcia. Fred?
Thanks. I support 6, 7, and 8. Yes, and early adoption. And I support C2 for the reasons Joyce went through. Thanks.
Thanks, Fred. Christine?
So I'll make it easy. 6, 7, and 8, I agree with staff recommendation. And I also agree with C2 for the reasons that were expressed by Joyce.
Thanks, Christine. Hillary?
I'm yes on 6, 7, and 8. Agree with the staff recommendations. With regards to question 9, I support alternative C2 for many of the reasons that were discussed today. I will say, well, I think this really comes down to a broader question about transactional versus not, because I can understand that in these circumstances, right, it's more transactional in nature. Is it necessary for us to go back to the beginning of the annual reporting period? I feel like we tend to make these decisions on a project by project basis, and sometimes it's based on kind of what we think the cost would be for having to go back in time. I wonder if there isn't more we could do from a broader perspective to think about that from a consistency standpoint. So that's probably something I just need to take back and think about, but I support C2 for purposes of this project.
Okay. Thanks, Hillary. So 6, 7, and 8, I agree with the staff recommendation. Question 9, I'm C1. And partially, I guess it's because I think our whole financial reporting system is set around annual reporting. And rightly or wrongly, interim reporting is simply a subset of that annual period. It's not an accumulation of those interim periods. Otherwise, we would issue 4 quarters of financial statements and never add them up. We issue annual, and we have accommodations all throughout interim reporting, including on materiality, how it's based on the annual amount. I do struggle with then presenting someone with an annual financial statement that, even if we think it's rare, the only reason we're picking between C1 and C2 is because we think it may happen with 2 different accountings for the exact same transaction, which is effectively what we'd be saying. And I certainly recognize transition is not principle based. It's a way to get from point A to point B. I do question how that's helpful. And that's probably just because I have a different view of annual reporting versus those who think interim reporting is really the primary basis. And you add 4 of those up and create an annual period. I don't believe that. So I'll keep going for C1 on everything we do. I'd also note it's early adoption. So you don't have to do it. So somebody wouldn't have to do it. They've been getting by with guidance today. They could get by with guidance in the future. So for all those reasons, and I'd also remind registrants, they still have to do SAB 74. So they may think that they're avoiding some cost of having to, in 2026, they didn't really adopt in the first quarter. They had a transaction, but our standard was already out. I'm pretty sure they have to disclose the SIB 74 effects of that to the extent they determine them. So just kind of interesting. So, but anyway, that would be my reasoning. So I'll turn it over to Jack then to bring us home. Jack?
Thank you, Rich. I will now discuss questions 10 and 11 on benefits and costs. Questions 10 and 11 ask the board to consider whether the expected benefits of the proposed amendments would justify the costs and if the staff can proceed to draft a final update for vote by written ballot. On the basis of feedback received from respondents and additional outreach, the staff thinks that the amendments in a final update would better reflect the economics of an exchange of debt instruments, enhance comparability, and provide more decision-useful information to investors. This feedback also informed the staff that stakeholders do not anticipate that entities would incur significant costs to implement the proposed amendments, and that the proposed guidance may even be less costly to apply than the current guidance. As such, the staff believes that the expected benefits of the amendments in the final update would justify the expected costs of implementing those amendments. With that, I will turn it over to the board to discuss questions 10 and 11.
Assuming no questions. Fred?
So I would like to highlight, I do think there's a real cost to this proposal. It's important to recognize that we're talking about very specific transactions where there is a contemporaneous exchange of cash. And these are referred to as exchange offer structures. Most of these today are low-cost ways for corporates to refinance. And most of these today achieve modification accounting. With the change that we're imposing today, most will hit these principles and most will be, therefore, would fall into an extinguishment bucket. The result of that, in my view, is that issuers who don't want extinguishment accounting will simply find a different structure for their refinancing, most likely a higher cost structure where they can apply the 10% test. There's plenty of structures out there where they could do that. So in my view, there is going to be, probably not material in the greater sense of things, but there is going to be real cost on preparers that I think we need to recognize. For those preparers who would prefer modification accounting, they'll have to weigh the costs and benefits of going to a different structure where they will achieve modification accounting or continuing with this structure, this low-cost structure. So there is a cost to it. I'm not going to dissent on this because I do think extinguish accounting, we heard from investors, it is more transparent. And we heard from practitioners that there is this kind of difficulty and cost associated with the 10% 10% test in these type of transactions. So I'm not going to dissent, but I do think we need to recognize that we are imposing a cost on the capital markets when we do this.
Thanks, Fred. Marcia?
Yes, I've received sufficient information, and yes, I think that this is guidance. I appreciate the whole process that the EITF went through to try and identify this issue as an area where there could be improvement. I think that the comments we received indicate that this is going to be operable. I think we've met the objectives of providing that improvement, and I give permission to ballot.
Thanks, Marcia. Joyce?
Yes to questions 10 and 11. I pretty much want to thank the EITF members for identifying this issue. And I appreciate the work that has been done in providing recommendations. And of course, the work that the staff has done in terms of distilling the comment letter responses and bringing us to this point in our analysis. I think that the staff maintained the intent going into this project. It has been a narrow scoped project addressing the transactions that are the common issue in practice. And there are potential gains and efficiencies, I think, in the financial reporting system and the potential for reduced costs by reducing the complexities and the time allotment challenges incurred by issuers in performing the multiple lender analysis under the current rules. So I think investors will benefit from this project, and I think that the outcome that they will favorably achieve is less diversity in practice and perhaps economically similar transactions being accounted for more comparably.
Joyce, so?
So I agree with the staff, or on the question 10, I have received sufficient information. On question 11, I think the expected benefits justify the cost, and I give the staff permission to ballot. I also want to thank the EITF for their work, their recommendations, and the staff support on this project as far as the outreach and supplemental work that they did on this. So,
Christine?
I also have received sufficient information, and I think that the benefits exceed the costs. I think it was Hillary that said earlier that there may be a need for a broader project on modification versus extinguishment accounting, and I would support that. I probably won't be here if such a project were taken on, so it's very cheap talk for me to say that. And since, cheap talk is cheap talk, I will add that I think there are a lot of problems on the right-hand side of the balance sheet with respect to liabilities and equity that at some point a board needs to take on. And I would like to just thank our stakeholders and the staff for their work on this project, as well as the EITF.
Well, thanks, Christine. Hillary?
With regards to question 10, I have received sufficient information, and I do believe that the benefits outweigh the costs. I want to thank the EITF for bringing this to our attention, for all of the feedback that we got from stakeholders through the comment letter process as well. I do think this is one of those instances where we are able to provide more decision useful information to investors at a lower cost to preparers. And I think that that is a real win-win from that standpoint. Certainly, I think that, as Christine mentioned, right, would be interested in a more broad look. But I do think that this is a good first step, right? I do think keeping it narrow within the context of the type of transactions that the EITF brought to us gives us an ability to have the EITF bring those more narrow issues and be able to work through those efficiently and effectively. And I do really want to thank all of our stakeholders for helping through that, and excited for this to be finalized.
Thanks, Hillary. So 10 and 11, yes and yes. When I think back to the original EITF discussions, what I heard were there are a variety of models in practice today that we couldn't find anywhere in GAAP that people were using to make this assessment. So I view this as taking that unwritten GAAP and inconsistent GAAP that's not in our standards and creating a consistent model for application. I certainly recognize that may have raised the profile of this issues with certain parties, but it was something they were already dealing with. They just didn't know they were dealing with it because they were at the mercy of individuals looking at transactions. I think this brings the consistency to the transactions. I also think it's helpful that at least we applied a consistent model as we work through our decision tree to costs, for example. And I also agree, although I think the issue is broader than debt modifications, I think we have all kinds of issues related to continuation versus new contracts. Throughout GAAP, we don't have a single model. We have a different model for almost every area of the codification. And that's probably something awfully big to try to deal with, particularly since we have new standards on leasing and RevRec that have different models for continuation versus new transactions, but probably does make sense at some point in time. Should we bring consistency to that whole concept of what's a new transaction and what's a continuation transaction in all of our accounting models? But maybe we'll hear that in our agenda outreach. So with that, I want to thank the EITF, thank our staff, thank all our stakeholders. I know a lot of work went into this. Sometimes when we're all done, it sounds like, boy, wasn't that simple? No, it wasn't. There was a lot of effort that came in along the way. So with that, I think why don't we take a 5-minute break while we bring in our next team? So I have 10:14 on my clock. So let's come back at 10:20 our time. So 6 minutes. Thanks very much, Steve.